All right, let's get started. Welcome everyone to today's startup webinar. Thank you for joining me today, Caitlin and Pierre. We're going to be talking about sort of a reality check today. The point of today's webinar is to share expertise and insights from both Pierre and Caitlin, who represent two of the, I would say, the world's largest investment firms or VCs focused on startups and scale-ups across the world. So to start with, maybe I'll just pass over to Caitlin. If you could please introduce yourself, followed by Pierre, please.
Absolutely. Well, Fadel, thank you so much for having me. And it's an honor to be addressing, I think, over 1,000 folks right now. So thank you so much for your time. The background on Drive and myself is Drive Capital was started about 8 years ago. Our founding partners, Chris and Mark, had actually been partners together at Sequoia, one of the very first venture capital firms in Silicon Valley, for a little over a decade. And really the thesis that spurred them to uproot their lives and move to Columbus, Ohio, of all places, to start Drive Capital was that they were continuing to see there was so much innovation happening outside of Silicon Valley. And at the time, they were passing on the opportunities to invest in companies if they were further than a bike ride from their Palo Alto office. And it just didn't make sense to them why you wouldn't prioritize partnering with entrepreneurs who are really choosing to build their businesses closer to their customers rather than just close to all the venture capital firms in Silicon Valley. So with that thesis, we got started in 2012. Since then, we've now grown to about 1.2 billion in assets under management. We're partnered with a little over 45 portfolio companies. And that can sound like a big number, and we're very honored to have those resources behind us, but we do view ourselves as still early stage investors. We like to be part of the company building. So our check size really ranges from anywhere from $500,000 for a seed stage business to up to much north of that for a later stage business. We love to just get involved with our startups and take a board seat and be as strategically helpful as our advice is worth, just from our experience with helping to support other entrepreneurs. We do have an operating team here that's fantastic as well in terms of helping to scale up on the talent side. If you're looking to add data scientists or engineers, we've got Robert leads our talent strategy there. And then Yasmin on the customer side just has an incredible network through the Fortune 500 that we've used for everything from customer relationships to go-to-market partnerships and independent board members and kind of everything in between. So that's a little bit about Drive. I'm really excited to be here, and I'm sure Pierre is going to give a way better introduction than that. So Fadel, thank you for letting me go first.
Thank you.
Not so sure. Thanks, Caitlin. Super happy to be with you here, and thank you, Fadel, and the full Nexford University team for organizing that. I think this is a great opportunity to meet with entrepreneurs, students worldwide that are interested in this field. Few words about me. So first, I'm French, obviously. You recognize the accent. The second part is I work for Creadev. I'm going to tell a few words about Creadev to understand the perspective of the answers we're going to give. Obviously can't speak for the full VC world, but I can give you my own perspective on that. So Creadev is a bit of a strange animal. We are an evergreen investment firm. We try to be global. So we're based in Paris, in Nairobi. I'm in charge of Africa, in Shanghai and in New York. And we're a bit later stage. We try to support existing startups in becoming big scale-ups and becoming best players in their sector. To do that, our perspective is to say that the shareholders' timing, the investors' timing should match more the entrepreneur's vision and up to an unlimited amount of time. So it's out of the classic 5 years, 7 years thing. To do that, we are backed by one single investor, which is the Mullier family. And just a word about that, it's an entrepreneur family that has been launching over 200 companies worldwide and with 600,000 collaborators in 35 countries, big in retail. And basically, we're trying to find the next champions with Creadev. We invested a bit more than 1.7 billion since 2002. And basically, so what we're looking for passionate entrepreneurs and that will basically have are developing innovative business model in essential goods and services for the many. We're looking for large markets, let's say over $1 billion markets, so that basically there is enough room for them to become a unicorn. We're looking for both the combination of the proof of concepts needs to be done and the strong growth profile, and really in each territory. So the New York team is looking for US champion, the Paris team for European champion, the Shanghai team for Asian champion, and here in Nairobi I'm looking for Pan-African champions. But anyway, I don't want to go into too much details. I'm super happy to be here and to have a discussion together with Caitlin, especially because I think we have like a different but really a combined point of view on this VC world.
Thank you, Pierre. Yeah, precisely. So Caitlin, is based in the US, Pierre is based in Africa. So I think between them, they'll be able to give us quite a global perspective today. Just to set the stage for today's webinar. So we have attendees from across the world. We're going to be talking about a bunch of different topics. We're going to be taking questions from all of you. I see a number of hands raised already. We're going to be stopping for question time every few minutes. You'll get to ask any question you like. The idea is really to add value to you as attendees from across the world. From Nexford's perspective, many of you will be familiar with what we do, but we are firm believers in the SME sector being a catalyst to creating job opportunities in emerging markets across the world. We know that markets like Nigeria, for instance, face a significant unemployment challenges. You have huge growth in population. The same story in places like India, to some extent as well in places like Indonesia. So what we believe in is essentially people need to build the skills that they'll need through education, whether it's certificates or degree programs, in order to build their own businesses or join young and fast-growing businesses. So the point of today is really to give you guys perspective that will help you if you're thinking of starting your business, or if you're just about to join a startup, or if you already have a startup and you're looking to grow that business. So to start with, I just want to talk about some of the key trends in 2020. Caitlin, maybe we can start with you. How has the startup landscape evolved over the past 6-7 months since the pandemic hit us? And what would you say are sort of the hottest sectors that you're seeing significant investor interest in, maybe as a result of the pandemic?
Absolutely. Well, I think it's a phenomenal question. I think what has occurred with the pandemic has been a real strong acceleration of trends that have been occurring that we anticipated would probably take maybe 5 to 10 years to occur. And what's really happened is the pandemic has sped that up and really brought it to a catalytic moment. So we've seen that really accelerate interest in a lot of different sectors. Telehealth is one of those. Certainly just figuring out how we can get healthcare to people without so much of a people-intensive mode as what we've been doing historically. I would also say insurance technology has been one of our companies that we actually incubated out of our offices here in 2013, one of our very first investments. Root Insurance just filed for IPO last week. So that's been, and I think with Lemonade Insurance and some of the other insurtechs that you've seen get into unicorn status, that's been something that's continued to accelerate. I would of course say education technology as well, with everyone trying to adapt to working remotely, as well as the trends that are of burgeoning middle class throughout the entire world. I think that there's a really strong gap right now that needs to be filled by really successful education technology companies like Nexford. And then there's more structural things that I would say are independent of the pandemic that we've seen start to accelerate around really just costs coming into control around things like technologies like LiDAR and robotics. It's just continued to accelerate interest there. So that's a free-ranging answer, but I would say that in terms of pandemic-influenced interest, I would say ed tech and insurtech are two of the strongest trends that we've seen.
Pierre, from your perspective?
I fully agree with what Caitlin's saying. We've seen the same trends. I have to say that it was a good opportunity if we can take something positive of this super negative time that we all had to survive and to go through. It's that basically because we couldn't actively do the due diligence and things like that, we basically could go deeper and look at the recent trends and go earlier, build relation with people we never have time to speak with. And what we really understood is that there is an acceleration, as Caitlin says. So it's not a big revolution. Everything is not going to change from one day to the other, but it's been an acceleration of those models in health tech, in healthcare as well, health tech, and even in food. One of our portfolio company is called Twiga Foods, and basically they are trying to disintermediate the complex logistics between the informal retail, which is in most sub-Saharan Africa cities, 90% of the retail, and the smallholder farmers. And basically what we realized is that everybody was keen to go to those online more digital model, and the COVID did help to realize that and to accelerate on this point. But otherwise, I'll definitely and I don't want to repeat what Caitlin has said, because EdTech from K-12 to and I think Nexford University is a great topic on this, to basically online MBAs and online tertiary educations. All of that is the new black, really the new thing that is pushing. We already saw that before the COVID, but it just made it obvious that it's a key one. Health tech wise, you can see the same trend.
Yeah, thank you. So clearly we're talking, I mean, there are some recurring themes here. We're talking about food, we're talking about health tech, and we're talking about education. And all of these are particularly, pressing topics in emerging markets, and as well as even in the US. Let's move over to a bit more of a reality check. So, we've been talking sort of high level, and okay, this is what's happening in the world. This is what's happening in the world. But as an entrepreneur myself, I want to side with some of the entrepreneurs that are with us today. Give us an inside view of, what is a VC really looking for, when investing? And it's a broad question. So if you could try to prioritize, say, 1, 2, maximum 3, what are sort of the 2 or 3 real priorities that you look for, when you're making an investment into a startup? Caitlin, should we start with you?
Absolutely. I would say one thing is really understanding the market size and the true addressable opportunity. There's sometimes where it feels like we've got really, really smart people and they've found this fantastic solution. The problem is that no one really thinks it's a big problem. So it can be technically a big addressable market, but in terms of people who actually really want to spend money on it, it can be a smaller market. So we at Drive tend to look for billion-dollar markets. That's really where we found we are able to be the most helpful partner. So I'd say it's market size, of truly addressable market size. 2 would be a why now. Nature hates a vacuum. So why? And I think the pandemic has created a real catalytic moment, but there's other trends as well that you can look to: structural changes and cost of an underlying material, or a cultural shift, or a demographic change. But there should be some factor that you can point to for why right now is the perfect time for your company to really step into this void and solve this enormous problem. And then I would say that 3 is we really do look for just understanding the team. And if you have a reason, a special insight through your personal experience that makes you just passionate about going out and solving this enormous problem. I think that the thing that sometimes gets lost in buzzy IPO stories is that it is a messy middle to get from the beginning of an idea to the end state, where everything is not figured out, but everything seems much more steady. There's going to be bumps in the road that you would never anticipate. So we look for founders that are just so passionate that they would do this for free if they could. They wake up in the middle of the night passionate about what they're working on. And that's something that I think all VCs look for, but particularly here at Drive, that's what gets us really excited. So those would be my 3.
Market size, why now, team. Mm-hmm. Those are your 3. So let me poke one of them before we move over to Pierre. So you said market size. You guys look for billion-dollar opportunities, right? Mm-hmm. We have attendees here from all across the world. I bet some of them might be thinking right now, well, I'm in, whether I'm in Kenya or I'm in, a small island in Indonesia or the Philippines. Maybe there isn't going to be a billion-dollar idea here, why is it not good enough if it's, you know, $100 million idea? So what would you say to entrepreneurs thinking and feeling sort of discouraged by that sort of sentiment? Maybe my idea is so good, but it's not going to be $1 billion idea.
You know what, I would say that first you can look at your local community, and if it's $100 million opportunity there, that's fantastic. So even taking maybe taking Root Insurance as an example, we started in Ohio, just in Ohio. And that was where we got our regulatory approval, and it was a long road to get there, not to take the punt on car insurance. But Ohio alone is not the billions of dollars of opportunity. I think you start focused, and then if you're able to achieve just in your local community this incredible opportunity, then it's, okay, how can I expand then from a global perspective? So I think it's fine to say, you know, where we're focused right now, this is a $10 million opportunity, or this is a $50 million opportunity. But then 5 years down the road, once we're able to prove this traction and we can expand this globally, then who knows, we could go into the billions of dollars. Or as our community continues to grow, that will continue to expand the market size. So I think focusing early is a boon to startups. It's a fantastic thing for startups to focus. But I think seeing the overall larger opportunity is where Drive focuses. There are other venture capital firms as well who aren't as focused on that really, really enormous market size, that are focused on maybe a smaller opportunity. That's just for Drive. We tend to want to see in 5 to 10 years down the road, is there an opportunity to get into the $1 billion market size?
Okay. Yeah. Do you need the billion as well?
Yes, I do need the billion as well, but I think that the last point mentioned by Caitlin is the most important one, is that there is as many different VCs as different projects. So it's super important. It needs to be a choice on both sides, because I understand that passionate entrepreneurs, they really want to go to the next step. So they are eager to get the money fast and to move on. But what's the added value of the VC beyond the dollar is even more important. So you need really to have a match in that. I'm not a big fan to the going in the same bed expression. I much more compare it with the wedding, and basically it's a long-term relation. So you need really to do the check and that. And if the VC such as the Drive Capital is asking for $1 billion, you need to really to understand why, and basically do you want to have the same story. And if not, it's good enough. You'll have other funds that are looking for a much smaller market and so on with different drivers. I do share the $1 billion market with Caitlin, because our aim is not to invest and divest and to make a financial return. Our aim is to support the growth of global champions at the end of the game. So we can give it 10 years, 20 years, not much longer, but and basically you need to have already a big market to do that. But if you're disrupting a market, for instance, I take back the example of Twiga because I already took it. It's this retail. So the market you're disrupting, this traditional retail, it's already massive. And if you succeed in doing it in Kenya, why not doing it all over Africa? So basically, it's not impossible to reach this $1 billion market figure as per se. But to answer to your question, basically, Fadel, I guess we have like 6 criteria. I won't take all of that. I share the passionate entrepreneurs. The way I describe passionate is both like a person, a woman or a man that is able to empower other people, that owns the strong vision, that is both like down to earth, not always crazy shooting for the moon, but also super ambitious, and as able to have already a local complementary team. It's super important from the beginning to have always the key people to help you. The second key one is innovative business models. We don't believe that innovative is all about tech, but it's just another way to do things that has not been implemented. It's super important for us. We really like this approach. I already spoke about the proof of concept and the scale engine, so I won't go there. But the last one is really to have a business model, a business plan that you can share with the entrepreneur, that you can share between the VC and the entrepreneur. And it's like a backbone of the relation that you're gonna have together. And it's not a crazy business plan that you need to put before the investment to just attract the investor. It's really something that will be the plan that you will both agree on after the investment, and that it's for us it's super important to have that. I could go in more details, but I'll stop here on this. What are the key criteria that the VC is looking for?
Thank you. So let's take a quick question from the audience. So we have a question on technology, which I'll rephrase a bit. So the participant is asking for recommendations on innovative tech companies. I think it's, let me rephrase that question. So as a founder, often founders lack the technical expertise required. So they have an idea, they know how to market it, they know how to build the business, but they lack the technical expertise. What advice would you guys have to, say, non-technical founders on how to fill that gap?
Yeah, absolutely. I would say that for us, finding a technical co-founder is, again, to borrow Pierre's excellent phrase around, totally agree that it is like a marriage with VCs and startups. I would also say finding your co-founder, your technical co-founder, is an even bigger decision, an even longer term marriage than the VCs, because you're going to be truly in the trenches with them every single day figuring this out. So there's actually startups that try and connect founders with technical co-founders. And there are a variety of other ways to try and find a technical co-founder. I do think if you don't have that technical expertise and your focus is going to be creating a technology company or a technology-enabled company, which I would encourage everyone to explore, because I think fundamentally, I think all companies are moving to being technology-enabled companies. So I think finding that technical co-founder is an absolutely critical step, and you want to make sure that they're aligned for the long-term vision that you are envisioning for this company. And two, just that you have a good communication style, and that you're able, that they kind of pass what we call the airport test, that if you got, I guess we'll have to come up with a new phrase now that we're in quarantine times, but if you were delayed at the airport with them for 3 hours, would you enjoy spending time with them? Because at a certain point, life is too short. If you just really, even if you find the most phenomenal person, if you just can't stand being with them, you're not going to enjoy building this startup with this person. So I guess the short answer is I would definitely say prioritizing finding a technical co-founder and really empowering that person that you enjoy working with to have some latitude in helping to build this with you is a critical step for non-technical founders. That's what we encourage our non-technical founders to do at that stage here at Drive.
Thank you. Yeah.
And to complete that, at a later stage of the company, we realize sometimes that the early technical founder, co-founder, might not be the guy that will be the big CTO of a large scale up, because it's not the same set of skills. But as long as he can manage CTOs that are better technical guys than himself, it's good enough. So I agree, it's super important to vet the technical co-founder for being a good co-founder, as well as being good in the technical aspect. Super important. And I guess this is something that young startup can also ask from their investors. When I was saying you should always look for something that more than the dollar, is to have this pool of resources or this network of connection, because at some stage you can't get from the day one the perfect CFO, the perfect CTO, the perfect COO, but you can expect that your investors in Series A or B, I don't know when, or depends on your specific setup, but give you access to this type of resource. It's really a key added value from investors that you should require.
Mm-hmm. Absolutely.
Let's move over to, we have another question from Femi. So it's sort of probably one of the most frequently asked questions in startup world, valuations. So Femi's asking two questions. So is there a threshold on percentage of equity a founder should give up when seeking investment? And then the second is, how does a founder value the percentage of equity equivalent to the amount of investment received? So it's sort of the same question asked in different ways. What advice would you guys give from your experience on what people can expect? Because there are normally sort of benchmarks per round, right? Every deal will be unique, but what sort of expectations can people have from seed all the way up to, say, Series B or C?
Absolutely. So I would say that is a very fair question. It's hard to answer without specifics. And I want to give really tactical advice, notwithstanding that. I would say it really comes back to understanding the type of investor that you're partnering with, to Pierre's point earlier. If it's someone who is going to take a board seat and bring operational expertise, help you find a technical co-founder, help you really build the engineering team, give you office space, like really be heavily involved, then typically that type of investor is going to want to write a larger check and optimize for a larger percentage of ownership, like in the 20 to 30 to 40% range. 40% would be for that would be very early stage, like a very pre-revenue company. So I would say that in that circumstance, it might seem at first gasp like, oh my goodness, I'm giving up so much of this idea. But I think that it really is warranted to take into account what this partner is giving you. I think if it's a convertible note or if it's a check without a lot of time coming behind it, then asking for a much smaller percentage is totally appropriate. I think it's just really trying to figure out what you feel like the best opportunity is to build the biggest company that you possibly can build and achieve your mission. And then I think it's a little bit more art than science in a lot of the early stage valuation. But I think that the way the venture capital community would think of it is they're going to be investing a lot of their time. So they'll want to try and get a bigger percentage because they're envisioning that they're going to help you build $1 billion business. And so over the course of that time, they're imagining that their ownership percentage will shrink. So I think that's where the venture capital community is thinking of it, not as trying to dilute founders, because our goal is to make sure that we're completely aligned with you and that you are excited about, again, just running through those brick walls and dealing with all of those headwinds to try and achieve the mission. So that's a little bit of a fuzzier answer than I can imagine the person that was asking the question was looking for. Happy to provide more specifics. It's just tough without knowing exactly what the business is or what the stage is at.
Yeah, I hear you. I mean, we heard one number. So you said, you up to 30, 40%, but I think the other key outtake is really think about what value the investor is going to bring in addition to the cash and factor that into the valuation when you think about it and see, okay, is that value going to help me really accomplish what I need to accomplish? And then think of what percentage you should give as a result of that.
Absolutely.
Yeah, you can add to that. Pierre, are you still there?
I totally, yeah, I'm still here. I totally agree with what Caitlin is saying. For us, the perspective is to say always that it's better to have a more limited percentage of a multi-billion-dollar company than 100% of nothing. And so you should really see this VC perspective of not the people that are taking part of your shares, but really as an enabler to reach this billion-dollar vision that you have in mind as an entrepreneur. So that's my first point. And we're not super fancy of this top valuation that each one is seeking for anti-dilution purpose or anything. For us, valuation is just one step after each other, and so it needs to be a transparent mechanism that we all agree on, and basically to avoid down valuation at the next one, which is a super negative sign both for the market, for your own motivation, and for all of that. So there is not a bit of magic, but I understand the point of an entrepreneur that don't wants to turn into a manager of his company because it's so diluted that this doesn't feel that is anymore a strong shareholders. For us, it's super important to let's say to never have, even of our billion-dollar companies that we have in our portfolio, we push the funders to dilute themselves, and you have like different mechanisms that are made for that, be it ESOP, be it share profit mechanism, and so on. And so basically, I won't be if you're really in line with the values of your investors. Make sure that he wants you to be an entrepreneur and a partner, because we partner with the entrepreneur. You don't partner with an asset, with an online university. We partner really with the entrepreneur. And so let's make sure that basically the valuation scheme is not too much in the focus of the discussion, but much more what's the long-term vision, and do I still feel as an entrepreneur of the story, with a share being above 10-20% at the end of the game.
Yeah.
Sorry, but I agree with Caitlin. It's difficult to really answer with figures without knowing a specific company, the stage of investments, and so on.
Sure. No, I think that makes a lot of sense. And if I may just add to that, if I wanted to give some simple advice from sort of my, entrepreneurship experience, I say there's probably a lot more founders out there who regretted not doing a deal because of, negotiating valuation versus founders who, did deals, but then went back, 3 years later and said, oh, I wish I had negotiated a higher valuation. So ultimately, you should really focus on the long term and say, okay, and how can we, if I'm going to give up X% more, what am I going to get in exchange for that? So focus on optimizing the value that the investor is going to give you more than negotiating, okay, I want 2 or 3, 4, 5% extra. Let's move on. We have a number of other questions, but let's move on to understanding how VCs work. So connected to my previous question, so can you walk us through sort of a simplified version of decision-making process on VC side? So, and everyone's so keen on getting investors, on pitching investors, reaching out to them. How do I find the right ones? But what advice would you offer or insight would you offer to help people understand how the decision-making process is actually taken, behind the scenes, so that when they approach you, they give you the information that you need in order to take a decision that serves their interests?
Absolutely. Well, I would say for us, it comes down to some of those 3 points that I'd highlighted earlier, just really making sure that we understand those. In terms of our decision-making process, this is another thing that is, as Pierre said, there's as many kinds of different venture capital firms as there are kinds of startups. So there's some venture capital firms where if you're talking to a senior investor, that senior investor is empowered to just make the decision of, we're going to invest, I believe in this, and I have conviction, and we're going to make the investment. Then there's other venture capital firms where you need to get a majority of the senior partners aligned, and then they'll make the investment, even if there's 1 or 2 dissenters. At Drive Capital, it's a unanimous senior partnership decision. So there's 6 senior partners, and if 1 senior partner says, I am not aligned and I don't think we should make this investment, even if all 5 of the other investors are excited about the investment, we decline to make the investment. It's happened more than a couple of times this year where we've had 1 investor who has just said that they could not get there on this investment. That can be incredibly frustrating when you're part of the majority, but we've found it to be the way, and we've discussed changing our orientation, but I think the reason that we've been excited about it is then when we make an investment, that portfolio company is all of the Drive senior investors' portfolio company. In that way, no matter at any bumps in the road, the entire partnership is completely convicted on seeing that company through. And I think it comes to Pierre's point about, we're not 3 to 5 year investors either. We're 7 to 10 year investors. So I think it's something where we view it as a marriage on our side as well. So all that to say, I think when you're handling those conversations with a venture capital firm, I think it's good to ask that question and just ask, how does your firm handle these things and what's your process like? We can also come to make this, for better or worse, we're all in or we're respectfully standing down, usually within a month. 2 to 4 weeks is typically how we make our decisions. Some venture capital firms are much longer than that, and some can move even more quickly than that. So I think it's about asking that venture capital firm, how do you make your decisions? And also asking for coaching from them and saying, is there anything in particular you think about the story that I'm not being crisp on, or succinct enough, or any other points that I need to touch on? I think being open and honest about that, and being open and honest about what you don't know as well, is always a great path forward to gaining alignment across the whole partnership.
Great. I want to kind of repeat that last point. If there's something you don't know, it's fine to say, I don't know, and be honest about that, and come back to the investor once you do get that info.
Absolutely. Yeah, I feel like that doesn't get said enough. We say that as partners around the table. We'll say, even once we've made an investment, we don't know. We're going to figure it out. I think intellectual honesty is always viewed very strongly.
Yeah. What's your insight?
Especially because all the we don't know is basically the key step to draft and design the 100-day plan after the investment. basically reinforce the weakness, and this is super important, because the reason I like the we don't know part is that we're not looking for the perfect company at an early stage, because nobody knows if it's going to be this $1 million company afterwards, $1 billion company afterwards. What we really want to understand is two things: is first, does it fit with our investment thesis? So will we be happy on that? And two, can we be a good investor? A good investor, which is always beyond the dollar. Can we bring value to this company? And to be able to answer those 2 points, all those questions are necessary, because you really need to understand the in depth the company vision, and so on. So for us, that's the most important. So that's why we value this due diligence part. I guess on our side, we're a bit longer than what Caitlin mentioned, because we never think about this just the first ticket. If we're doing an investment in a Series B, we're not considering the 5-10 million we're going to put there, but potentially also the 30 million we're going to put at the next one, and the next one, and so on. So that's, for us, that's super important, to be able to ask as many questions as possible, to understand basically all the potential weakness of this business, to say, facing those weaknesses, do we have a potential action plan to help them be a champion? And on some points, they say, no, they are so strong on that, even if we're not relevant, it's okay, because they're already quite strong. So this phasing is super important. And I agree with Caitlin, as said, it's like, ask question in the process, because it's part of the discussion. And if you think it's too complex, not adequate, and so on, please find another VC. And if you feel the process is too easy, I say beware, because because then you won't have your added value beyond the dollar.
Sure. We have a question from Norman. So Norman's asking, he says something quite common as well. And he has ideas. His people have ideas. Ideas are cheap. He also has technical knowledge. So he says he has Java programming, Android programs, so a bunch of different programming skills. But his challenge, his or hers, I think his, is monetization. So the question really is, what is the monetization process, or what, is there a process? What advice would you offer to those with technical ideas or business ideas with the ability to implement them technically, but who don't have the experience to really figure out, how do I monetize this idea? Is there a process, or should monetization actually come from the very beginning? Could an idea not be a great idea if it doesn't have a clear path to monetization?
So I think it's a great question. I would say, again, it's kind of depends on the VC. There's some VCs that are excited about investing in a company without a clear path to monetization, and there's some VCs where they'll decline to really engage and have that first conversation if there isn't some monetization. Because to Fadl's point, they'll just say, if people aren't willing to pay for it, I can't be sure that this is a valuable business. At Drive, we're investors in a company called Duolingo, which does language learning. And only about, I think, less than 10% of the users have opted into the premium plan at Duolingo, where that's how Duolingo gets paid. When we invested in Duolingo, Louise was very passionate about not forcing people to pay. It's a mission for him, and he thinks that everyone should have access to language learning. We made that investment when there was no monetization and there was no clear path to monetization, because we felt like the engagement and the retention metrics were world-class, and they were acquiring all their users organically. So we believed that eventually we would figure out a way to monetize. We just knew that this was a successful business based on the underlying fundamentals of the company. But not all venture capital firms will feel that way. I think that the way to experiment with monetization, or the way to figure out the right path to monetization, in my view, would be to first make sure that you have those metrics around, if it's a direct-to-consumer business, which I'm assuming it is, that you have those bright metrics around organic viral growth, really high engagement, really strong retention, and then you can experiment. I think advertising is a really tough way to monetize. I think you've just got to get to such a huge quorum of people that it can be a really big challenge. But experimenting with some type of upsells or a freemium model or a subscription model in certain groups, and doing kind of testing around A/B of like trying a subscription model in this group and seeing if that really, destroys your organic growth or destroys retention. And then you figure out, okay, that's not going to be the right way to go, or we're not big enough yet to figure that out. That would be the way I would suggest trying to experiment and seeing if you can start to monetize. But I would encourage you to just continue to focus on the fundamentals of your business, because there are venture capital firms out there that will see a path through and would still be excited about partnering if all the fundamentals are really strong.
If I could paraphrase, I mean, if you don't have a path to monetization, you need to have other really solid metrics. It can't be, this is a great idea and I think it's great. And, you need to have outstanding metrics that could almost compensate for the lack of, a monetization path until you eventually figure out a path to monetization.
Absolutely. Very well said, Fauvet.
Thanks. Yeah. Anything to add to that? Would you invest in a company that doesn't have a path to monetization yet?
Not. No, and that's why it's interesting to see that there's a different profile. No, because we only invest post revenue.
Yeah.
With few exceptions, because we like exception always, and we are like investing in plant-based foods, and so you invest first in the tool and then before generating the revenue. But I don't think this is the thing our investment committee is most at ease with, and I understand why. But it really means that you need to pick your so one VC is not like another, and maybe it's a good tip is really to understand the DNA of your VC. And the fact that Caitlin was open to look at such businesses shows that the type of risk profile they are able to get, and that's super important.
Let's take this interesting question from Prasetyo from Indonesia. So he says, my startup is called Profesi. It's a game changer in migrant recruitment industry. Obviously, my startup has been affected by this pandemic, given that they can't send workers overseas anymore. So, the whole concept of pivoting, what advice would you have to startups who need to pivot and need to weather through, extreme circumstances like what we're facing right now?
Yeah, I think it's a severe challenge. I think that some of the best companies have been created through pivots. So I think not being shy about really going back down to first principles and seeing how your core insight around your business could be useful. So I think that what I would assume your insight might be is that we're continuing to see the workforce go into more of a globally inclusive community, and we're increasingly being aware that there's top-notch talent in all over the world, not just within Silicon Valley. So I think creating that understanding and that insight and trying to encourage folks to still recruit migrants, but just be working more remotely, in particular, and maybe in different fields than what you've been serving historically, might be one aspect to go. That's really your decision as the CEO. But I think going back to your core insight and going back to first principles is always a good practice when we see the need to pivot. I wish you all the best of luck. That's a tough hand to be dealt, for sure.
No, it's a tough one indeed, and I guess a good benchmark of the different solutions that's been implemented to go in the point of Caitlin, which is to say how to provide the same service without basically sending the workers and abroad. Is like you have model like, for instance, in across Africa, a model called Andela, which is basically a solution to train the person to first have them working long distance, mostly dev people, and then once they are vetted by the company and that the borders open up, they can basically move there. So maybe you can find a SaaS solution or an in-between solution where you can start with distance working before doing that. But this is really one key point where we value our entrepreneur, their capacity to adapt to the situation, and also where the entrepreneur should value their investor, their capacity to support in tough situation. To go back to this pandemic issue, I think that was a great challenge in a way that we always say that we support entrepreneurs and we are super pushy in good times. So when they are doing a great year, we say, why didn't you do more? And and that's always a bit frustrating to hear on the entrepreneur side. But well, they're having a tough year and they don't reach, for instance, the pandemic. You obviously couldn't do the BP. We're not asking them why they didn't do that. We try to be super supportive in this time. And so I guess this is exactly this type of situation where you can test a bit of the DNA of your investors on that to basically brainstorm together on what can be the next idea to make the business survive. But I'll join the greeting from Caitlin and saying good luck to you and to Prasetio, if I pronounce it well.
Yeah, yeah. We have a couple of more interesting questions. Let's start with, so we have a question from Precious, who's saying, what's the typical speed of growth a VC will want a business to grow at from round to round? So let's say, from seed to A, from A to B.
Gosh, so that is also, it's somewhat dependent on the venture capital firm as well. If they're optimizing for creating the billion-dollar companies and looking for more of those billion-dollar markets, I would say they're typically looking for something on the lines of 100% year-over-year growth. And again, that doesn't necessarily have to be monetization for folks that are willing to invest pre-revenue, but it would have to be really, really strong metrics underlying the business. Again, that's a tough one to answer without a little bit more context. I would say that another benchmark that we tend to use internally is just looking for how much money needs to be raised to get you to that next milestone. So I think typically around a Series B, we'd think about trying to get the company to a point where they're ready for really large growth investors. So that'd be over $1 million a month has been historically a bit of a benchmark. I think that's starting to flatten out a bit, but maybe I'm getting down a bit of a rabbit hole. I would say the short answer is it's a tough question to answer, and that there's different VCs that are prioritizing different things.
Well, let's say as sort of the minimum, or if we look at the median figure, so from seed to A, would you say doubling every year is sort of a reasonable benchmark, or is it? Yeah.
I would say that's reasonable for what we look for here at Drive.
Pierre, do you need more than double?
Yeah, it depends on the stage. I guess at super early stage, I need doubling is a good target. I don't really pay much attention to the letters to the series A, B, C. It's just that it's a level of maturity of company. I guess at the seed you need still to fine tune your team, your idea, your model, and basically you might be pre-revenue. So that's why we come at late stage Series A or Series B. At a point where basically Series A, you have the idea, the proof of concept starts to be done, and you really accelerate your growth. And Series B, I'll say you expand beyond your natural base. So I'm in Africa, where for instance, in Kenya, where the country is 40, 50 million people, but basically you need to expand to go international. I will put it at the Series B level. What matters on that, because everybody has different definition, and that's good enough. It's basically to make sure that the money you're raising is linked to use of proceeds, that it's super clear and that you can deliver. And that's the only thing that really matters in our view.
Yeah. So if I can paraphrase that last part, I would say, beyond the growth, I think what we heard from Pierre is investors are looking to see, okay, I'm going to invest X dollars. I want to know how this money is going to be used. And I want to know that this money is going to help you accomplish the milestones you need to get to the next round. So regardless of how much it is or your growth, the point is looking at the outcomes and not the output. I think that's a mistake a lot of startups make. They'll be like, oh, we're going to use this money for this, and that. But then you look, okay, well, is that going to actually help you accomplish the milestones you need to raise your next round? Or is this just nice to have progress? And there's a difference between sort of nice to have progress versus, validating your company's on track for the next round.
Absolutely.
So we have a question again on Africa. So a lot of questions actually on Africa saying, we have all these great ideas and we have traction, but there aren't enough investors in Africa compared to say the US or elsewhere. Obviously, Pierre and Creadev, you're there to change that. What would you have to say to all these, African entrepreneurs saying, they're not able to find investors? I think most of them seem to be in Nigeria.
Yeah, I think that's a. Oh, sorry. Go ahead, Pierre. I've been jumping on far too often. Let's have Pierre go.
No worries, no worries. No, I like this question a lot, and I love the energy that you can find within the Nigeria and full Africa, but specifically in Nigeria within the ecosystem. But you can find them a lot in Kenya, a lot in many other countries, and I disagree with this statement on that. I think it's super frustrating with that, but I think that there is more money available on the market than great projects to invest in. And it's a bit provocative, and I make it this way on purpose. Basically, it's what is true is that the money, the investors are always looking at the visible part of the iceberg. So always looking at the same 5% of projects that are well marketed and things like that. And I would say to Caitlin, there is a lot of US cultured entrepreneur or US citizen launching projects across different countries in Africa. And based on the US culture, without going into too much cliche, they are born marketers. So they're super good at marketing their projects, but basically they get all the visibility of that. And it might be frustrating for the entrepreneurs that basically are not as good as marketing their project. And so you're right. The investors should pay more attention and more time looking at the other part of the iceberg, because you have great projects there. But still, all in all, I believe there is more money on the market than great projects. So there is a positive part of that, meaning that the money is there and is available, and that I keep on with the same message. It's beyond the money. Look at the added value, because you're going to find it. You're going to find the money, but look at the added value that you require from your investor to make sure there is a good match on that.
So, Caitlin, I just want to, push on that point a bit further, because I totally agree with Pierre. And we have a similar question from Charles, who's saying, do VCs invest in upcoming markets in sub-Saharan Africa, like prop tech? He's saying there's so much investment going into prop tech, but in saturated markets. So what would you say? I know this is a bit of a theoretical question, Caitlin, but Americans are in many ways perceived to be sort of born marketers. Like, so you go to the US, you look at all these startups in California, to Texas, to Ohio, you're like, wow, this is amazing. And you look at the websites, you're like, this company is going to kill it. It's amazing. And then you actually start looking and digging into the company. You're like, okay, there's actually not much there. And yet, they're doing an amazing job, on raising money. But and not necessarily on sales, but on raising money. And then you look at places like, sub-Saharan Africa, and you find like serious intellectual property, for instance, on agribusiness or on, health tech business, but their pitch and their marketing is 1990s. You look at it like, I'm totally not interested in this startup. So that's just the reality, I'm African by background, right? I grew up in Egypt. So this is no offense to Africa, but what would you say to Africans? How can they polish their sort of, look and feel to get more appealing?
Absolutely. Well, and so I think to take the question from the top, and then I'd love to touch on that as well, Fadel. I do agree with Pierre that there's been more money flooded into venture capital firms than ever before. And I think when you see things like Square buying, I think it was Paystack in Nigeria last week for $200 million, you're starting to see, and our investment in Applyboard back in March, you're starting to see more of a global appreciation for the opportunities in sub-Saharan Africa and in emerging communities. I would say that there's a bias towards the really strong marketed companies. And I think it's because there's a view where if we're going to create this billion-dollar company, there's going to be multiple rounds of financing. So even if we've taken the time to understand the story, we need to believe that other venture capital firms are also going to be investing. So I think that's part of where the bias comes from. I think it's real that you're going to face more of an uphill battle than someone right in Silicon Valley. But I think don't let that discourage you, because I think just taking a little bit more of that polish, as Fadl said, I think it's about really being very crisp and being very focused about what differentiates you in this opportunity. I think your odds of getting financing have never been greater than at this moment. And I think it's only going to continue to accelerate in that way. I also think there's a growing disillusionment with all of those born marketers, where you see companies like Quibi and Theranos and Magic Leap who've raised billions of dollars and it's just plummeted into nothing. I think that there's been a reversion now to a bit more substance. And I couldn't be a bigger fan of this move. But so I say all that to say, I understand where the frustration behind that question comes from, but I think that your odds now of getting funding have never been greater, and they're going to continue to accelerate. So don't lose hope.
That's encouraging, and yeah, 100%. When you look at the amount of investments happening worldwide, it's never been greater. So to follow up on that point, are there specific sort of key learnings that you think founders or startups in so-called emerging markets could apply? If you could choose, say, one or two that you've seen, say, from the US, Caitlin, whether from Silicon Valley or elsewhere, models that used to work but no longer work that should be avoided. Do any come to mind?
Ooh, models that used to work that should be avoided. I think I can think of models that used to be funded that are growing a little bit out of vogue. I think anything where if the advantage of the way that your business is conducting its mission versus how folks have been doing it before is purely on cost, then traditionally that is not as exciting for a venture capital firm as a totally different way of approaching. I think it comes back to Pierre's point on really innovative business models are not typically only predicated upon cost. Because from our point of view, if we think about it 10, and for Pierre, 20 years down the road, typically if it's purely around cost, that cost advantage will be arbitraged over time. So it'll just continue you'll continue to have more competitors coming in. I think where you can really differentiate around brand or around partnerships and relationships and network, or if you're really innovating around a faster response time where you're able to more quickly update your content or your solution suite for the changing and adapting world. I think something around that has to be the fulcrum on which your company spins rather than purely on cost. So hopefully that's helpful, Fadl.
It is. Pierre, anything to add?
I totally agree with the long-lasting barrier to entry or key advantage versus the other, which cannot be based on cost, because you need to imagine that you will always have a better competitor doing better on cost than you are. So you need to have something more than that. I'll not answer your question. I'll put it differently. I say that doing a copy paste from another ecosystem might be tricky, especially in sub-Saharan Africa. For instance, I've seen a lot of people willing to do like copy paste from top-notch models from the Bay Area, especially in the tech environment. But basically, they found it some difficulties in adapting a pure tech model in a country where you can't rely on the third-party logistics or things like that. So basically, at some point, you cannot do a pure copy-paste. You need to take into consideration the local context. And for instance, a pure marketplace, well, you need to make sure that as you can't have third-party logistics, you need to integrate that at the beginning within your own model and so on. So basically, I've seen a lot of great entrepreneurs willing to really adapt on their countries what they've seen in the US or in Europe. It needs to be made with a lot of local flavor to work.
Thank you. We're almost out of time. Let's take a couple of quick questions. We have a question on exit. So it's actually Femi again. So Femi is asking, is it a must to have an exit plan when you pitch a VC? As a founder, we're often passionate. We want to be in this for the long term. Are exits critical?
Not
So
for me.
Pierre, you go first, please.
No, it's super it's a key point, and again, it depends on the DNA of the investor. So, you need to know who you're speaking to. So, if like somebody comes to me and says for 10 minutes, I want to go to IPO, I want to exit in 3 years and things like that, I say, great, but you've not understood at all what I want to build, because I want to build long-term champion. And yet, once I say that, at the same time, I don't believe that even if you're a super young entrepreneur, you can sign for 30 years involvement. So it means that it's always good to show to the investor you've been thinking of what could happen and have your different options lined up. Um, Meaning that having already an idea of who's going to replace you in 10 years, or having an idea to have like some partial exits to have some money to be basically able to build a live side of your business and so on. And most especially, what if you're not anymore the best pilot to drive the growth of your business? So to be ready to exit for the good of your business. So it's first answer, know the DNA of your thing. If you understand you're going into a fund that needs to exit within 3 years, you need to show them that you have clearly an exit plan. If you're okay with that, don't create it if it's fake. Really, if you want to exit in 3 years, show them the plan. That the other ways, the exit is not always because of the investor. It might be also because of the business life. And at some point, what's the best for the company is always the good thinking to have when thinking about exits. But I'm sure, Caitlin, it's more of a day-to-day topic for Caitlin on this specific point.
Caitlin, if you could also incorporate in your answer sort of your advice when it comes to optimizing for exit. A lot of founders will be sort of predetermined or a bit too obsessed on with exit before even building the business.
Yeah, so I agree with Pierre that the way Drive thinks about it is if we hear the founder talking about an exit during the pitch, we know that we're not probably a good fit for that, unless it's a very, very late stage and they're talking about an IPO in 5 years or something like that. We love to build the long-term billion-dollar business as well. So we would be encouraging Femi and any other entrepreneurs to be dreaming really big. That's the type of investor that we are. As Pierre said, there's easy clues to figure out if you're talking to a venture capital firm that does optimize for exit. They'll have it on their website that they are able to achieve exits within a certain amount of time or something to that effect. Or you can even reach out to, in their portfolio, you could reach out to some of the CEOs in their startups and just say, hey, I'm pitching this VC, and what do they look for? What type of a partner are they? Definitely would encourage any entrepreneur, if you're thinking about a venture capital partner, if they're not offering you the opportunity to chat with the CEOs they're partnered with, they should be, and you should certainly be doing that diligence before you sign the final check. We don't optimize for exit. We optimize for the best long-term business. But I would say that there are some venture capital firms where if you say that, they're going to shy away. So it's just good to know your audience. I think that's probably the overarching theme of a lot of what Pierre and I have touched on is there's just a lot of different flavors to venture capital firms. So it's good to do just a little bit of homework and understand what they're optimizing for before you chat with them.
Right. Well, thank you so much. Thanks to both of you. Thank you for everyone who's joined us from all across the world. You guys know how to reach Nexford. If we can help support you guys and offer advice and put you in touch with any of our advisors, we're happy to do that. To Pierre and Caitlin, thank you for joining us. We got so many questions we weren't able to answer, and so many requests for how do people get in touch with you. So what works best? How do people get in touch with you guys?
Yeah, absolutely. So if you just go to the Drive Capital website, there's a link for my email and my LinkedIn. Please feel free to reach out with any other questions. And thank you so much for the time.
Yeah, how do we get in touch with you?
Likewise, I guess on the website, and depending on the country you're in, if you're in Europe, reach the Europe team and so on and so forth. In the US, the New York team will be all happy to answer your questions. And if you want to reach me, I guess LinkedIn is a good way to get into contact with me. Thanks a lot again, Fadil and the Nexford University and Caitlin for this interesting chat.
Thank you, everyone. Thanks a lot.
Thank you.
Bye.